In today's video, we are going to talk about the concept of internal range liquidity to external range liquidity, starting from the basics. We are going to talk about the concept used in internal range liquidity to external range liquidity, how to apply it, and how it actually forms on the chart. Basically, every single thing you need to understand about internal range liquidity to external range liquidity to get yourself started with this concept. Now, internal range liquidity to external range liquidity mainly consists of two concepts. The first one is swing points, just as we can see here, and the second one is fair value gaps, just as we can see here. Now, let's start with swing points. A swing point is a 3-candle pattern where the middle candle is longer than the candles on both sides. Just as we can see in this example, here we have candle 1, and then we can see that this candle 2 is the middle candle, and you can see it is longer than candle 1 and candle 3. This candle then becomes our swing low. Now, we also have this exact one, and it's very similar. We have candle 1, we have candle 2, and then we have candle 3. Now you can see candle 2 is higher than candle 1 and candle 3. This then becomes our swing high. That's just basically it. Now for a fair value gap consists of 3 candles. The first candle can do whatever it wants, but the second candle has to be an impulsive candle. And then the third candle's low should not align with the first candle's high. That then gives us a bullish fair value gap. Now for a bearish fair value gap, the first candle can form however it likes, but the second candle has to be an impulsive candle. And then the third candle's high should not align with the first candle's low. That gap then becomes our bearish fair value gap. Now, when you combine these two concepts together, that is what gives us the concept of internal range liquidity to external range liquidity. The fair value gap right here is our internal range liquidity, and then the swing high becomes our external range liquidity, and this is for a bullish scenario. And for a bearish scenario, the internal range liquidity is a bearish fair value gap, and the external range liquidity is the swing low that price left. Now, the concept of internal range liquidity to external range liquidity is very simple, and the concept just states that when price comes into an internal range liquidity, it usually targets an external range liquidity next, and when price hits an external range liquidity, it often comes back into an internal range liquidity. And that's how price naturally moves from internal to external liquidity and then back again. And this is how it looks in a chart format. In a bullish example, when price taps into an internal range liquidity, we expect price to push to an external range liquidity. And then in a bearish scenario, when price taps into an internal range liquidity, we then expect price to push to an external range liquidity. And that's the concept for internal to external range liquidity. Now let's look at the concept of external to internal. What this means is when price takes out external range liquidity, our focus should then shift to price coming back into an internal range liquidity. And this is for a bullish scenario. And for a bearish scenario, when price takes out an external range liquidity, we should then be anticipating for price to come back into an internal range liquidity. Just as simple as that. The concept of internal range liquidity to external range liquidity also aligns very well with the concept of market structure. And that's one of the reasons why it's so relevant. When price is trending, it usually moves in either a bullish market structure or a bearish market structure. Here we can see price forming lower highs and lower lows. Here we can see our first lower low, and then a lower high, and then a lower low, a lower high, and so on and so forth. This gives us a bearish market structure. In this example here, we can see price forming a bullish market structure. So here we can see a higher high, a higher low, a higher high, a higher low, and so on and so forth. This is a bullish market structure. Now, most of the time, when price forms a lower high, it usually forms that lower high inside an internal range liquidity. And that is exactly what we can see here. We can see that this lower high formed inside an internal range liquidity. This lower high formed inside an internal range liquidity. This lower high formed inside an internal range liquidity. This lower high again formed inside an internal range liquidity. And whenever price gets into an internal range liquidity, what happens next? The external range liquidity gets taken out. So here we can see the first external range liquidity was taken out. The second external range liquidity was taken out, and that is just how price moves. And in a bullish example, we can see this is our internal range liquidity. Price tapped into it, went to external range liquidity. After taking out external range liquidity, price comes back into an internal range liquidity and then takes out external range liquidity, then comes back into an internal range liquidity and then takes out external range liquidity. This is just how price moves. This is the cycle of the market. And once you understand that internal to external range liquidity works with market structure, then all you have to do is look for your trades from this internal range liquidity and then target external range liquidity. That's just all you need to do to become a profitable trader. Now, let's look at an example. So here we have the GBP USD 1 hour time frame. Here we can see the price is clearly in a bearish trend. Price has been giving us bearish market structure. Here we have the lower high, the lower low, the lower high, the lower low, the lower high, the lower low, the lower high, the lower low. So you can just see price has been creating lower lows and lower highs until it got to this level. We had a shift in market structure, and then price gave us a higher high, a higher low, and then a new higher high. Now, one very important thing I want you to note is where these lower highs actually formed. And when you look at it well, you would see that each of these lower high formed inside an internal range liquidity. And this is the first lower high we saw. It formed inside this fair value gap. And what the price do, took out external range liquidity. This lower high formed inside this fair value gap, took out external range liquidity. This one formed inside this fair value gap. Even though this was a minor fair value gap, but price still respected it and took out external range liquidity. And here we can see price came back inside this internal range liquidity and took out external range liquidity. Same thing we can see here. Price came back into an internal range liquidity, took out external range liquidity, and then we had a structure break to the upside. So now we'll be anticipating for price to come back into a bullish internal range liquidity so that that cycle of bullish order flow should start. So and right here we can see price came back into an internal range liquidity, a very small fair value gap, but price you respected it and eventually took out the external range liquidity. And this is one of the thousands example you can actually see in the charts. This happens day in and day out, right? But you can't just go to the market and start looking for price to come back into an internal range liquidity to external range liquidity to then take your trade. You need to have context behind it. And that is where it comes to how I use the concept of internal range liquidity to external range liquidity. The first way I use the concept of internal range liquidity to external range liquidity is I use it to get my bias. And the second way is to identify order flow. So how I use it to get my bias is, let's say this is the daily chart, and then we see the price is inside an internal range liquidity. What this tells me is that in the coming days, I should be expecting external range liquidity to get taken out next. But instead of just buying immediately price gets inside the internal range liquidity, that wouldn't make a whole lot of sense, because when price was coming back into this internal range liquidity, in your intermediate time frame, price would have been creating lower lows and lower highs, and you don't want to be buying when price is creating bearish market structure. So what we are going to do is we first of all wait for price to shift structure to the upside, and then start creating bullish order flow, which is price needs to start giving us bullish internal range liquidities for us to be able to take our trade. So instead of you entering here, what you will do is you wait for a market structure shift and then wait for price to come back into a bullish internal range liquidity, which then aligns with your bias. And once price comes back into an internal range liquidity in your intermediate time frame, you can then go down to your lower time frame to then look for an entry in this level and target external range liquidity. Just as we can also see here, when price comes back into this internal range liquidity, you then go down to your lower time frame, look for an entry, and then target external range liquidity. And you're just going to consistently do this until price then takes out the overall external range liquidity you had for your buyers. And once price takes out that external range liquidity, you then start waiting for price to retrace back into an internal range liquidity for you to continue that cycle. So before I end this video, I want to give you guys a quick assignment. Go to any pair of your choice and open either the 1 hour or the 4 hour time frame. Then the first thing I want you to do is identify the market structure. Determine whether we are bullish or we are bearish. So the next step is to mark out where the lower highs or the higher lows formed. Now everything depends on where the market structure was. So if the market structure was bullish, then you should identify where each individual higher low formed. But if the market was bearish, you should identify where each lower high formed. Then after you do that, identify the internal range liquidity at those areas. So when you look at each individual lower highs or higher lows, identify if that higher low or lower high formed inside an internal range liquidity. Then after you have identified that, then I want you to check if price completed that cycle. That is, if price actually went to external range liquidity. That's just all I want you to do. So just go to the charts, identify as many as possible. And yeah, this is where we're going to end this video. If it was impactful to you, please give it a thumbs up and subscribe. I'll see you guys in the next one.